By the end of this video, you should know how you can convert the sale of your home into a lifetime of guaranteed tax-favorable retirement income. Hi, I'm Gordon Weeb. I'm registered as an underwriter in the provinces of BC, Alberta, and Saskatchewan. My practice focuses on helping clients meet and achieve their goals, typically through the use of annuities. Just before we begin, regulations require the following safe harbor. This presentation is produced and published on and around August 25th, 2020. It is for illustration purposes only. This is not an offer to purchase securities or products. No representation is made. Items presented here may not be suitable for everyone. Values and rates will fluctuate, sometimes wildly. Please consult an experienced qualified licensed professional prior to investing or employing strategies to ensure that your investments are a part of a comprehensive plan designed to help you and your family meet your long-term financial goals and objectives. Also, when recommending products and planning strategies, broad tax and legal issues may be discussed. Nothing should be construed as tax or legal advice. There. Now that we've navigated the compliance waters, let's sail on. Here's our agenda. We're going to discuss some of the advantages of selling your primary residence. Number 2, we'll discuss the current challenges for drawing an income from traditional investments. Number 3, we'll assess some of the risks and limitations of traditional investments. Number 4, we'll introduce an annuity strategy and its advantages. And number 5, we'll explore and consider any downside. Selling a family house is a common strategy for Canadians looking to retire. It comes with a built-in advantage, namely, there are no capital gain taxes on the sale of a primary residence. After realtors, lawyers, and bankers are paid, homeowners are entitled to all of the remaining equity. This downsizing strategy typically has 2 or 3 parts. First, a portion of that equity is used to purchase a retirement residence. Second, the residual amount is often used for retirement income, with a portion perhaps going to finance some other lifelong dream. Should you wish to draw retirement income from the proceeds, there are some fundamental questions you will need to answer. First, how long will you live? What is your life expectancy? Second, if you invest, what sort of rate of return can you expect? And third, how much risk do you expect to expose your lifetime savings to? There was a time when retirees could put their funds into a bank savings account, but these days, a savings account pays maybe 1 to 2% on deposits, and the interest must be declared as taxable income, so your after-tax return will be even less. Now, there are no estate considerations given to a bank account. At the time of death, a savings account assets are frozen until an executor is legally appointed and the bank's fees are paid. Some try to get around this by setting up joint accounts, but that is riddled with shortcomings which are ignored at your peril, or to the detriment of your preferred beneficiaries. Should you decide to park your funds with the bank and simply live off the principal, you then must assume how long you plan to live. Now, the fastest growing demographic in Canada are centurions, so if you need the funds for 30 years, you can pay yourself 3.33% of your funds per year, or about $277 for every $100,000 in bank deposits. If you've lived hard and fast and you only expect to live 12 years, you can withdraw 8.33% every year, or about $691 every month for 12 years. The thing is, what if you live longer than 12 years? That's highly likely. You'll be out of income and at the mercy of friends, family, government. Probably not a great way to spend the rest of your days. Should you choose to invest, there are numerous items needing to be considered. First, interest rates are at record lows. 10-year Government of Canada bonds are paying less than 1% per year. If you invested $100,000 in such a bond, you would receive roughly $300 every 6 months, or about $6,000 over the next 10 years. Second, stocks are setting record highs, with valuations being driven in part by lower corporate taxes and lower interest rates. Company valuations are currently pretty rich, and it's difficult to think that future market growth will match the returns of the last few years. Even blue chip dividends are at risk during a global pandemic. Recent headlines reflect some of those risks. To be sure, there are a number of risks that exist for anyone looking to invest home sale proceeds in this environment. They include 1. Knowing who is going to manage the funds and for how long. 2. Figuring out a reasonable rate of return on your investments. 3. Anticipating your life expectancy. 4. Planning for a change in your cognitive functions and abilities. 5. Anticipating future tax liabilities. I review these risks in other videos on this YouTube channel. The links can also be found in the notes below. So when it comes to managing your funds earmarked for retirement income, I believe there is one immutable rule, and that is this: retirement income is better than retirement savings. It's why I suggest viewers, prospects, and clients purchase a guaranteed lifetime annuity with a large portion of the proceeds from the sale of their primary residence. An annuity is a very simple, straightforward instrument. In exchange for a deposit or a premium, a life insurance company will agree to pay you and/or your spouse or partner a guaranteed income for life. Here's how it works. Payout rates or ratios are determined by age, gender, and the number of lives for whom you wish to guarantee income. Most want to ensure their spouses are included, for instance. Given the age, gender, and marital status of a designated population, actuaries can be fairly accurate about determining life expectancies. Now, they can't tell you which lives will survive longer. They can only calculate the number of survivors in any given year. So, when purchasing annuities, the risk is borne by the underwriter or the insurance company, but it is shared amongst the participants. According to the Canadian Institute of Actuaries, a population of single, 72-year-old males have an average life expectancy of about 13 years, 8 months. A similar population of single, similar-aged females has an average life expectancy of about 15 years, 11 months. With couples, life expectancy is increased. There is an expectation that, on average, one spouse will survive 20 years plus. Now, just so you know, figures are a little out of date, and they originate from a report completed some 20 years ago. Average life expectancies will now even be longer. Now remember, the figures represent averages. So while there's an expectation that some of those single 72-year-old males won't survive the average 13 years, 8 months, a large percentage of them will survive, and they will live even longer still. Life expectancy is a bit of a moving target, and it increases as people age. That's because the population that didn't survive lowered the previous life expectancy. Here are some of the rates that were available for 71-year-olds on August 10, 2020. All of the rates assume a deposit of $100,000 and a 10-year guarantee payout period, with residual income going to designated beneficiaries. Rates are highly competitive and even surpass income available from other assets like savings accounts, bonds, equities, or dividend-paying stocks. And unlike any of the previous investments, your income is guaranteed. But there are other advantages to purchasing an annuity with which you may not be aware. Remember earlier in the presentation I mentioned how there were no capital gains on the sale of a primary residence? Well, a non-registered annuity benefits from similar tax consideration. You see, an annuity rate is based on mortality credits versus rates of return. Annual income is mostly made up of your own money. It's a return of your capital, and that is a non-taxable event. When you receive annuity income from a non-registered source, like the sale of a primary residence, you can have those funds flow for the rest of your days virtually tax-free. And even though you will be receiving more monthly income, it will have little effect upon your taxes owed from other sources like CPP, OAS, pensions, and investments. And with applying for government programs like pharmacare or housing allowances, annuity income is not included. You may qualify for available seniors programs more easily. You will also qualify for a non-refundable pension income tax credit of up to $2,000 a year. So that's the plan. If you sold or are planning to sell a primary residence, consider purchasing a guaranteed prescribed annuity with the proceeds. Your income will be guaranteed, it will never be reduced, it can never be assigned or seized by creditors, it will flow to you in a tax-favored manner, and it will likely help you reduce your overall tax liability, regardless of future tax increases, interest rate changes, or market swings. And should you not survive the guaranteed period, which are typically 5, 7, 10, and 15 years, you can designate beneficiaries to receive the income stream. In summary, selling your primary residence provides you and your partner with an opportunity to secure a lifetime of guaranteed tax-favored income. If your objective is to avoid outliving your funds while deriving a competitive rate, other savings and investment vehicles simply don't measure up. And that's it. If you have questions or would like further information about how you can guarantee lifetime income and reduce the risk to your retirement, please contact me, Gordon Weeb, by email at gord@think-income.com or visit my website at www.think-income.com. Thanks for watching. If you found this presentation helpful and informative, please give it a thumbs up down below, or consider subscribing to my channel or even watching one of the other presentations. The links are also down below. And please remember, stay safe, stay sage, and stay well.